Okay, so in the last practice problem, we looked at how deposits affect the money supply and how they show up on T accounts. For this practice problem, we're going to do the reverse and make sure we can see how the same process works with a withdrawal. So in this case, BSB holds 250 million deposits and a reserve ratio of 10%. So we can start to drop these ideas in. They've got $250 million in deposits times 10%. 250 times 10% equals 25 million in reserves. So reserves here are 25 million. And if all other money is loaned out, then we can drop down here and say that loans must be equal to the difference, which is 225 million, to bring this account into balance. So part two, BSB's primary depositor withdraws $10 million in cash from her account. What does this do to their reserves? Well, the immediate thing we know is that in order to pay out a withdrawal, the bank has to give away its reserves, because its reserves, remember, are ultimately its cash. So its reserves are going to decrease by $10 million, leaving only $15 million in reserves. That 10 million, of course, is also going to come out of liabilities, as they no longer owe that money to this depositor, and they now only owe 240 million in deposits. If BSB wants to maintain or restore its reserve ratio at 10%, what action should it take? Again, I'm not going to show a new T account here, but we can continue to manipulate this T account in a couple different ways. So the first thing we have to realize is that this T account is now not showing a 10% reserve ratio. $240 million times 10% means that this bank needs to be holding $24 million, whereas they're only holding 15. So first question is, how are they going to get 9 million, which is what they need, to fulfill their reserves? Where are they going to get this $9 million from? The answer there, the primary answer, is that they are going to sell some of their loans or their assets. We assumed it was loans. It, of course, could have been bonds. But they're going to sell loans or assets to other banks, to other individuals or corporations, and that can get them $9 million back into their reserves and back into that cash pile. If we wanted to think about what might happen at the end of a business day if they couldn't make this happen, hypothetically, they could also borrow some money from another bank or potentially even from the Fed. But so they're going to borrow, or we're going to focus on the idea of selling some loans. So how does that show up? Well, if we subtract $9 million from their loans, they would then have $216 million in loans, and then we could add a plus 9 over here to get them back to exactly the 24 million reserve ratio that this bank wants to hold. Final problem here, what is the potential money multiplier in this situation, assuming all other banks hold the same reserve ratio, and how would the action in part B, or really here the deposit or the withdrawal from the deposits, affect the money supply? So first, of course, our money multiplier is equal to 1 over the reserve ratio. 1 over 0.1 is going to give us a money multiplier of 10. And then we come back to our equation. The change in the money supply is equal to the money multiplier times the change in excess reserves. And the biggest question students tend to have here is, where are excess reserves in this problem? Because of the withdrawal, we didn't see an excess. In fact, what we saw was a lack of reserves in this bank. And what I would primarily point out to you is to remember that loans are created by excess reserves. They are not actually excess reserves in this moment, but the only reason this bank was able to create loans was because they had excess cash in the first place. So this negative 9 million is really what has happened to their reserves over the course of this problem. So the reserves in this bank have technically decreased by $9 million. We can multiply that by our money multiplier of 10 and see that the change in the money supply would be negative $90 million. In other words, by taking money out of this bank, this depositor has removed this bank's ability to loan that money. And that has caused our money multiplier to work in reverse. If this bank cannot loan its $9 million, then another bank cannot hold on to its loan of some portion of that money, or really loses its deposit of some portion of that money, which means they eventually lose their loaning capability. So this money multiplier, just like the spending multiplier and the tax multiplier, can work in both directions as we put it into effect and look for this consequence on the money supply. That money supply effect can be negative when there's a withdrawal from a bank.